Greetings, Dr. Jeffrey Scott. This is my weekend market MRI Pro update for this will be posted late night Friday, early morning Saturday, October 11th, 2025. Part 1, the markets. Again, my name is Jeffrey Scott, marketmripro@gmail.com. My Google group is called Top Down Trader, and my website is marketmripro.com. A couple times this week, I made some comments about concerns that I was having. I talked about breadth multiple times. I talked about Hindenburg omens in yesterday's video. And today, the question is this the beginning of a big move down, or is it going to be a bear trap? And I can argue both ways. I'll show you some things supporting both of those arguments. Either way, I think with markets selling off on such heavy volume today, what matters is where will they open on Monday. And the early return is that the markets have already dropped after the hours on Friday. If they open up down big on Monday, I think we could intraday trigger at least short-term oversold buy signal and see a significant bounce and rally. I think if we open higher, it's going to have a high risk of failure and fading the rest of the session. So I think where they open really matters. And I will wait to do part 2, which will probably also be a lot about the market, not just about stocks, until after the futures are out on Monday or Sunday night. Another variable that could impact or make this all about stocks is that the bond markets close for Columbus Day. So it should be an interesting day. And I can make a teeny weeny chart as I did here, and you could just see breaking support and big sell-offs on the spider Qs, diamonds, the Russell, a spike in the VIX. So a lot of damage. And let's go take a look at where we are. But first, this is for educational purposes only. Anything we recommend are in the spirit of education and not investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You alone are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock I mention in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. And I've got tools in multiple platforms and look forward to introducing you to the MetaStock platform, especially if you already own MetaStock, which has some charting advantages and the international stocks. If you're looking for the wealth charts video, it'll be there Monday morning. And again, I'll wait till after the futures come out Sunday and do it right before I go to bed, give you a sense of where I think this market is going. Personally, I hope we drop 500 points or more at the open. And no, not just because I've got some protection on, because we'll put in a short-term bottom. We're pretty oversold right now, but it happens so fast. Join my Google group, Top Down Trader. Just go to Google Groups, go to all groups, look for Top Down Trader. Love to have you. You'll get a discount on my tools and you'll get invited to some of the things that I do that I don't do on YouTube. And the other thing is you get notice when I put them out there for YouTube. I have a live meeting coming up very soon in South Florida, October 26 and 27. I put everything into these meetings. The same people come back, and just like everything else I do in this world of trading, I don't advertise well, I don't market, I don't keep a big mailing list. So it's usually the same bunch of folks, and that's cool. We've built some nice relationship over the years, but they keep coming back probably for a reason. It's not just because it's nice in October in Florida. Frankly, it's been kind of wet. It's at the Marriott Palm Beach Gardens, 2 packed days of education, software, instruction. It's $12.50, but that gets you breakfast, lunch, and dinner on Sunday, breakfast and lunch on Monday, lots of snacks and fluids throughout the day. You'll get a copy of all my PowerPoints, you'll get the recordings. There is an online option as well. And everybody who signs up and pays at the list there, which is everybody except for a few that already have bought every one of my tools and the rebate won't help, will get a $400 rebate that they can use towards the next meeting or to buy some of my tools. It's a full service Marriott. I have the code to give you. It's 155 a night. Now, if you're really adventuresome and you really want a great educational weekend, come in Thursday night, sign up for John Person's seminar, which is Friday and Saturday, and then come to mine on Sunday and Monday and get two for the price of one airfare, two seminar fees, but one airfare. If you're interested, Jeffrey Scott at marketmripro@gmail.com. I am probably close to full for in the room. I was going to lock it at 12 because of my boat. And we're pretty close there. Had a flurry of people sign up today, which was great to see. I can go higher, but some of them that go higher will get a rebate for dinner on Sunday because they won't be able to go on the boat because anything more than 12 on my boat gets a little bit crowded, but we'll play that one by ear. So let me know if you're interested. I'm going to keep looking for a recession for a couple of reasons. One, the data is still coming out, which means it's not part of the Fed shutdown. But two, it's because I know that whatever happens in this market, if this news today about the China tariffs going to 100%, if this trade war with China becomes a bigger deal and the market continues to sell off, and we start laying off federal workers, which is not typically what I remember happening during these shutdowns, we could go into recession sooner than later. And if you look at bear markets during a good economy versus a recession, oh, 20%, 25%. I mean, we haven't had more than a 19%, I think, on the spiders in 3 years. But if we go into a recession, that's when you see those 50% drawdowns. So it matters. Now, why do I say we'll have a recession? Because every time whether you look at the 10 minus 3 month, 10 minus 2 year yield curve, every time it drops below the zero line, you get the gray bars. And this is going back to the 80s. Drop, gray bars, drop, gray bars, drop, gray bars, drop. We're waiting on the gray bars. What do the gray bars signify? A recession. And you got it here, drop gray bars, drop gray bars, drop gray bars, drop gray bars, drop gray bars. Kind of a drop and a gray bar, and where's our gray bar here? So I think I am remaining on, and I feel like it's the right thing to do, recession watch. Now, other things that we might see would be a spike in the cost of and difficulty of getting money, which is this options adjusted spread here. We're not seeing a spike right now. And I think it was surprising, and this is almost a month old, not because the Fed isn't reporting, but because it only comes out once a month. But the Philadelphia Fed Diffusion Index, which measures general economic activity, at least in that area of the country, surprised to the upside last month, which, like many other things, suggests that we still have a decent economy. Know your news and earnings. Again, massive number of Fed speakers this coming week. In yellow are all kinds of things like retail sales, EPI, CPIs, jobless claims that we may not get unless the government comes to a settlement very quickly. And even if they get the settlement, are they ready to give us that data? In red, we should get the Empire State Manufacturing, the Beige Book, Philadelphia Fed Manufacturing, and Home Builder Confidence, but it's what we don't get. And, even though I am definitely in the camp, the Fed cuts, and I'm starting to think that the Fed may even be more likely to go to a bigger cut the longer this federal shutdown goes. Um, they're going in without knowing I'm sure they know more than we do on the data, but they really don't. These things are not released. So they're going to be going in blind and trying to figure out what to do with rates. It's an interesting time. So Monday, Columbus Day, markets are open. I did check to verify that. Fastenal in the morning Monday, that's it on earnings. On Tuesday, we got the banks. JP Morgan, BlackRock, Goldman Sachs, BlackRock not really a bank, Citibank, Wells Fargo, we got Big Pharma and J&J. Today, AstraZeneca was talking about a deal with the feds, and that could impact big drug companies as well. We got some technology, more banks, more pharma, regional banks, airlines on Wednesday, and then full days on Thursday and Friday. And I think it's the following week where it gets interesting with Netflix, among others, coming out. It is a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your earnings date is scheduled. And, last night I talked about sometimes how the Hindenburg omen is frustrating to me because it doesn't always show up at the same time on different platforms. And the reason for that, I believe, is these two columns at the end, which is the percentage of 52-week new highs and 52-week new lows. Um, it's easy to know what the new highs and new lows are, but the variable from product to product is what is in the stock list and how many stocks. Um, if you go look at the NYSE unfiltered, there's all kinds of crap in it. A lot of bond funds, interest bearing notes, weird stuff, preferred stock. I don't think they really are relevant. And so everybody cleans it up differently. I used to subscribe to a service called Lowry at a ridiculous price a month because they had a cleaned up version of the NYSE, which we could run studies on. Well, I think we got to heed this, Cindy, and let me tell you why. Upper left-hand corner, this is HGSI. This is the standard. It is a great program. There is a learning curve. It's where I, you know, learn my stuff. These little red lines above the stock chart are Hindenburg omens on the NYSE on the daily. So you now have 3 this week. This was the last set of the confirmed wins, which, by the way, are not that far away from here. And just for the sake of continuing, this is a person sell signal, John Person, that came in Thursday. This is a pocket pivot down, which may not be something that Morales or Catcher care about or pay attention to. They never talk about it. I like to look for them. And then there's 2 momentum signals to the downside in a row. And this is on the NYSE. So according to HGSI, we need to heed the Hindi. On Edge Rater, we had 2 Hindis this week. On the Q Edge tool, on the left is what's called, this is from Sagar Nandi. It's a great product. All this stuff is great. We had a confirmed Hindi occurring today, and we had one a couple days ago, and that's why it's confirmed. And this is on the combination of the NYSE and the NASDAQ, his total market view. But if you just look here at the NASDAQ, they had a Hindi today that's not confirmed, but you had a confirmed Hindi on the NYSE. So if it looks like a duck, it smells like a duck, and it quacks, it's probably not a chicken. In regards to Market MRI Pro, I spoke today with Praveen, and what we're going to do is we're going to filter the NYSE for anything that has an interest rate, bonds, preferred, or anything in the name or symbol, and see if we can't reduce the number of stocks that are reported in the different market breadth tools. Why? Because if you include all that junk, you might dilute out the 52-week highs and lows. So I do think it's time to heed the Hindi. I think we're going lower, but my early guess is we're probably going to bounce before that happens. Now, we're going lower, at least at the open. We are at support, which could end up holding, and I'll show you the guppy charts, which show there's no damage yet. Onto the charts. So if we go into this is my tool, mine and Praveen's, it's called Market MRI Pro. It was designed to facilitate a relatively fast, simple workflow of what I have thought have been some of the best top-down tools that I've been exposed to over the last number of, well, since I started trading, 30 years. Let's start here with some of the major ETFs. The VIX was up 12.69, no surprise. The VIX is, I showed you the cup, and I've been wondering if that wasn't the sign of a breakout coming, closing right at the top of its range. The dollar was down 50 cents. It was up a little bit earlier. The diamonds were the best performer, and they were down 1.86, Spider 2.7, Russell 2.99, and the Qs were down 3.47. And notice each of those finished at the lowest of the day. And like I said, it looks like they dropped a few hundred more points after the market closed. When I look at the futures, they're down 1,100, and they weren't down that much when the market closed. So a little sell-off in the 15 minutes between the cash close and the futures close, I guess. What else can I tell you about this? Bitcoin was down 3.7, also near the bottom of the range. Massive increase in the number of new highs, new lows rather, on the NYSE and the NASDAQ. And I'm real surprised we didn't trigger the Hindi today. We did trigger the Hindi today. Let me take that back. Surprised that we didn't trigger it yesterday. But you could see, and I'll show you that in a few minutes, that new high, new lows have turned negative. Look at the S&P 500 sectors. Staples was flat. The only things that were the next three, which were all down a lot, were utilities, real estate, healthcare, the defensive plays. The more aggressive technology, energy, discretionary were down between 2.78 and 4%. It was a rough day. Not only was it a rough day, when you look at the week, you could see energy was down 4% over the last 5 days, the big loser. And the only two things up on the week are staples and utilities, think defensive. Now, you want to know how bad it is? Look at the number of sectors were up. No sectors were positive in any of these three broad-based major industries. Less than 10% or about 10% of the industry were up. Only 9% of the stocks in the S&P 1500 were up. Only 12% in the NASDAQ and 12% in NYSE. If you made money, it's because you were short today or you were an incredibly lucky or good stock picker. It was a dramatically bad day. Now, here is a 5-minute chart of what we saw today. And I just thought I'd show you because the market initially was okay and was bouncing around at the highs of the session. Here's where it closed. Here's where it was after the open. Not a big difference. And then the Trump tariff tantrum part 2. Raising it to 100% and getting into a war, which may be smart. I'm not saying it's dumb, to fight over the lack of access to rare earth metals that are important for everything from defense to space to, what else was I going to say? Our technologies, semiconductor industries. So this battle looks real. This is why you've seen investments in LAC. You saw investments by the government in rare earth. You saw metals this week. You saw an investment in MP a month ago. The rare earth metals are an issue. So not only did the markets drop, but they dropped the rest of the session. As you could see, we're in a world of hurt, at least for one day. What happens on Monday? Like I said, I'm hoping it gaps down and closes with a hammer, meaning it comes up the rest of the day, and that could stop this fall and maybe give us attempt to set new highs. I just think if we gap up with all the technical damage that we had today and the concerns in the market, that it will just fade the rest of the day and keep going lower. But we will see. I'll be watching closely. which I don't normally do, but it seems that kind of a day. Timing brief. Here's the dailies. You can see the massive cuts here. So we flipped the bongos on every of the major indices. We cut through the WMA and kind of reversed, frankly, from a closing perspective, all the way back to September 11th. And that's on the, depending on which one you look at, that's on the Russell, on about September 10th, same about time on the spiders. That's a pretty big candle. September 17th there on the Qs, and really all the way back to September 8th. So that was taking out, gosh, 20 days, 15, 20 trading days. That's a big down day. Now, the good news is if you look at the weekly, you get a sense that this was a big down day as well, but it did not trigger the bongo anywhere, which is nice to see. And it's really nowhere close. And when you think about where we came, how much damage did we get today? Yes. If you look at the weekly chart on the spider, pretty close to a bearish engulfing pattern on the week. This is not the pattern that says to me bounce and go to higher highs on Monday. This is a pattern that I would think we would have a couple more, another week or two down perhaps. But look back here, we had that happen and we opened up and traded higher the rest of the time. And then we'll have days like this, a similar candle, close higher the next day and fail and come back down. Now, the other thing that I thought looked interesting, let's look at the Russell. Let's see if I can show this on this chart. That I'm hoping that we don't have deja vu. Here are three different tops. And if we put a horizontal line, which may or may not let me do here, let's see. Yeah, we'll just leave that line there. Notice what happened with the last two tops. False breakouts and a tremendous drop in the markets. Is this strike three? And is this going to pull the markets lower? I don't know, but I do think it's relatively interesting that this pattern seems to be repeating itself. All right, so let me do trend lines, but not the horizontal. So I'm a little nervous on that case. Now let me show you what's not so bad as we keep going. Guppy charts. I've been doing these for a long time, and it gives me a sense of the big picture. And it's just a zillion moving averages plotted against the major weekly indexes. Are we anywhere close to any of these moving averages, which start, I believe, at the 50 period and go to 300? No. And in fact, not only do we know we're close, but they're in the right order. And let's look at the dailies. So the dailies look like we're breaking down into the moving averages. May take a few seconds. I assume I can do daily with this chart. And I'm not certain we can do daily, so I'll come back to it later and look, but I don't see any damage there. And pullbacks are normal parts of the market. If we look at the US index ETFs, this on the daily charts, let's blow them up and look. Massive sell-off today on the spider. Yes, down 2.7%. Seasonality is not horrible here. And oh, by the way, what was our target? Our target was the 50. We still have not come down and hit the target yet. Then we probably have something in this range below the 50. So a drop and then a bounce and a close above the 50 tomorrow, on Monday rather, could be a nice reversal. 50 was my target before I got really nervous. Notice the big volume. In fact, I don't think you saw volume like this until the bottoms were put in April. I don't know if that's good or bad. All right. You could see the on-balance volume also turned down, which is bad. If we look at the Qs, we're going to see the same exact thing. Pretty significant volume. Really, the last time we topped it was with any significance was back at the low in April. Target still the 50, not that far away from it, and the Qs today were down 3.47. Diamonds pulled right into the 50. Now, will they bounce or they go to the 200? The 200's at 434.17, and they closed at 454, so it's only 4 or 5% more. It could pull back there and still be okay in an uptrend. Hope not, unless you're short, because that would be a little bit of pain in the market. One of the problems with trading growth stocks is that they'll fall 3 or 4 times what the market does. So there are probably people out there who had a growth stock portfolio not protected, who dropped 6, 7, 8% today. I know before I learned the power of protection, that could have been me. Today was not a bad day because, as I talked about the last couple of days, I bought puts on TQQQ, puts on diamonds, puts on TNA, all of which were down a lot. And on most of my naked positions, I put puts on them. And Baidu, I put puts on 140. Thank goodness, because it's below 120 after hours. Um, so I played defensive. Did I make money today? No, I lost a little bit, but not like it could have been. I'll just put it that way. The Russell, um, Russell was down 3%, heading towards that 50. And again, a bounce into that 50, even an undercut of that 50 and rally and close above would not be a horrible thing. And the diamonds, I can't remember if I even looked at the diamonds, but it's the same exact story. The volatility, remember how we've been wondering why it wasn't low? How it had come down and it was kind of like doing a rounded thing. Look at the move on volatility today, getting up to where the highs were with several of the recent bumps. A breakout above here, I think that goes much higher, and that's bad for the markets. We'll see. I think there's certainly risk of that, but I'm not sure the markets don't have a little bit more down and then go higher, and I'll show you some of those reasons as we go forward. Interestingly, I talked all week about that I wondered if the dollar would falter at the 200 day, and it did. And even though it looks like it's had a big gain, when you look where it's come from, it's still consolidating after a big fall. All right, now let's go out of this. Let's go look at commodities. Yeah, sometimes commodities are a place to hide during market disasters like we saw. And gold had a bounce after a big sell-off on Thursday, down 1.8 on Thursday and was up 1% today. If the 17-day was its support, it's still a ways away from that. Gold still super strong. Silver, just take a look at that. Silver was up 1.61 and had this big hammer. I mean, take this candle in your eyes, all right, but have it be an open white box. Let it open, drop hard, and close higher on the day, and that's a reversal candle. This is kind of a reversal candle too, but I'm thinking about what Monday might look like on the indices. Oil dropped hard today, below the 200, down 4.3%. Wow. And then oil and natural gas dropped below the 50, so it's back to being dead to me. And I guess if you want some good news, drop in both 2.4% on the 10-year, 2.1 something on the 30-year. So the bonds cooled off a bit, but you don't like them cooling off because the rates cooling off because the bonds jumped because of the fear of what's going on in the marketplace. Here is one piece of evidence of why we're probably getting close to a bounce. But before you get too excited about that, I will point out that I've shown you before that even though it's nice to see the buckets with 37% below their Bollinger Bands of the NYSE, 44% below the S&P 1500, 42% below the bands on the Russell 2000, and 24% on the NASDAQ, which typically means we are going to see a bounce on Monday. I just want to remind you of why I look to see if there's a recession, because you could see 40% here on October 2nd. I think it's 2nd. Let me see. I put my glasses on. I'm sorry about that. And October 3rd. On October 6th, we had 50% of the buckets. This is the S&P 1500. Were below. On October 7th, we went to 70% below. Eased off to 50 on the 8th. On the 9th, back to the 70s. And then we started to recover, and we were only 35 below on the 10th. So the point of that is not anything except to show you that even though this suggests that we have a bounce imminent because of oversold and the number of stocks trading below their Bollinger Bands, it can get worse. I don't think it gets much worse here. We're not in a recession. And back then we were, but it can get worse. The market breadth tool, you can see a hard sell-off on the NYSE. So if this was a flag, it kind of broke down below the 50. You can see stocks above the moving averages are starting to get where you see recoveries. And let's see if that's true. No. In April, you got a lot lower. So you could still get more days of negativity to pull this thing further down. What else can you see? New high, new lows, negative, AD lines, very negative, up, down, volume, negative, and there's our Hindenburg Omen. I think the reason we didn't get one earlier in the week is because we're looking at an NYSE that probably needs to be filtered a little bit. And as I mentioned, Praveen's doing that, hopefully get it done over the weekend. Not that it matters because we've already triggered the downside. Now we're going to look for evidence that this is getting better. Here it is on the NASDAQ as well, which also had a hard sell-off, but did not break its 50-day moving average. If we look at my bigger market breadth tool, which either is being pushed or should be pushed, let's do an autopsy on the spider here. And let's get you some more data. Okay. All right, this is what I wanted to show you. And let's highlight this day. Okay. The new high, new low 13-week, which is the first green box, is at 0.24. Wow, we're going to bounce. Well, we did bounce here at 0.14, but the reason why I made my bottom call back here in April, oh, come on, Jeffrey, don't keep doing that, was because we got down to 0.35. So the good news is, man, I am so bad with this mouse. The good news is we are down and getting close, but we're at 0.24, okay? And when we truly bottomed, we are at 0. So there's a ways to go on that. Just like there's a ways to go on the stocks above the moving averages, a ways to go on the AD line, and a ways to go on the RS. So when I look at it on the smaller chart and I spread it out so I can see just the last couple of dates, I thought, oh, wow, something's happening. But no, you have to open it up and look at more dates to see how it compared to the last low. So this is the spider, and we are at 0.33 on the NASDAQ composite, 0.22 on the Russell 2000, and where are we here? Still 0.40, so we got a ways to go. And so we have a ways to go before we're oversold enough to say this is done. So I think we get a short-term bounce. The question is whether it happens Monday, Tuesday, or Wednesday. And if it happens on Monday, is it at 9:30 or in the afternoon? And of course, it's not just about technicals here. We also have to be concerned about what happens over the weekend. Does the rhetoric increase, or does Trump not say a word about China and we stew, which may be just as bad, and maybe what happens is he's going to be busy with Israel. And hey, I don't care what side of that thing you're on. Thank God that seems to be coming to an end. The hostages will come back, and then hopefully they can start to feed and heal what's left of Gaza, rebuild, and maybe they can find a lasting peace. And if that's the case, Trump's legacy will be pretty darn good. But obviously, he's got to know when to keep his mouth open and not. And I'm not making a political comment. So if we go back to the ratio charts just to get a sense of what's working, we can see Bitcoin that was really strong sold off over the last couple of days. I'm going to go through each of these. Materials, horrible. Communications, neutral. Energy, weak. Notice how staples, which have been horrible, well, what comes up when the markets do horrible? Well, staples. So staples are holding up. Discretionary, no. Healthcare also is super strong right now and held up relative. Now remember, these are ratio charts. So the fact that healthcare is up doesn't mean that healthcare was up. It just means it was down less than the spider was down. So kind of interesting that technology, a little bit of weakening, industrials weak, utilities is another one of these things that does well during bad markets. Real estate popped a little bit, but I don't think it's going to do much until rates come down and people start selling their houses. Because you can't buy them until somebody sells them. But I don't know why the world seems so dumb. If people aren't selling the houses because they're in mortgages that are at 2% and they don't want a mortgage of 7%, but they've been paying their rent or their payment every time on time, no delays, no delinquencies. Why don't we pass a law to make mortgages portable so that if you have $2 million mortgage on your current house, and in Florida that buys you 3 bedrooms, 2 baths, and a broken down everything. But if you have a $2 million of a mortgage left that you owe, and you want to buy a $3 million house, why can't you bring that first mortgage with and have the people that buy your house let them pay off what you owe on the first house, which you're going to do anyways, and then keep that loan and apply to the second house. It seems like there should be a way, but you don't pay me for being political. By the way, you don't pay me anything. I just like to talk. All right, so let's look at a couple of things. It's nothing held up well today, except for things that I tell you held up like this. And I'll show you what I mean. This is a stock I liked yesterday, and technically it held up pretty well. I'll probably look over the weekend at what stocks did the best, held up, because if we do get a rally, those that held up during this market sell-off might be the ones that lead on the next leg up. But Sire, I still like this a lot. Lot of excitement, and I saw somebody came out with a $45 target based upon their drugs for ulcerative colitis or or irritable bowel syndrome. So the things that work when the markets get bad, McKesson. What did McKesson do today? Not quite all-time highs, but a positive day in a horrible market. Cencora used to be known as AmerisourceBergen. Why anybody would give up a ticker of ABC? Looks like Cencora might be setting an all-time high today. Horrible day in the market, but not for drug distributors. And then how about Cardinal Health? There are places you could hide. CAH, not an all-time high, but it held up very well. So these guys, these three drug distributors, are places that I'll park money on. Now, I cannot buy this, Altria. Why can't I buy it? Because don't you think it'd be a little bit of a joke for a cancer doctor to invest in a tobacco stock? Now, maybe I shouldn't think that way, and I should only think about my pocketbook. But Altria pays a 7.62% dividend, and it loves bad markets because money's going to flow into this for the dividend and the fact that it's a steady staple. All right, that's Altria. Um, there are others as well in the tobacco space that will be doing okay. If we look at the top down and we look at who led, well, nothing's green. And we look at the least bad, and this is going on the 3,800 or so stocks in my universe. So defensive, real estate, materials, we're leaders. Now it's interesting. I'm going to look at the 2-day force, and I'm going to look at healthcare instead of basic materials. If we look at by the same 2-day force, what are the best 10-day, not just force, it's a couple of different things, best industry groups. There's tobacco, so you got Altria that we looked at, you got Philip Morris breaking out above this. If that was a stock that we liked, we'd be excited. Um, British Tobacco, BTI. I haven't looked at this one. I'd rather buy MO. It looks the best of them. We got agriculture. We got medical distribution, the ones I just talked about. We got beverages. We got food. 1, 2, 3, 4, 5. Food, 6. REITs. Those are the top 10 industry groups. Let's look at by 2-day force or 2-day, it's more than force. I keep calling it force. It's a modified force that takes out the benefit of being one of these stocks that has massive volume. So Pepsi, pretty defensive play. Pop, big breakout today. Bad market. Pepsi was up 3.71, pays a 3.4 something dividend. I'll leave that open. We already looked at Cencora and McKesson. Philip Morris, breaking above the 200, pays a 4.38. Coke, again, a very defensive name. Breaking above the 200, pays a 1.63. Calm, I think of these guys as eggs, too low down there for me. Turning Point Brands, another consumer staple. Okay, we can just go down the list. Post. Um, these are not the kind of stocks that I typically buy. They're very defensive plays. Well, of course they are because of what the market did. So as a top-down investor, I look at the top and I'm not going down. I think that the market is unattractive right now to be adding to longs before the market works its way out, which is why when I do my Sunday night, I'm going to probably not have a lot of stocks for you. I don't want to encourage buying until the market settles down a little bit. Um, I have questions about my scans. The A plus scan requires stocks to be of a price and volume. It requires, let's see, I have to go back, a recent squeeze. Let me pull up one of the stocks so I can remember what's in it. Okay. This one requires the two momentum dots. It requires a price and volume minimum. It requires that the daily and the weekly relative strength have crossed over, with the daily crossing over fairly recently. And it's designed to capture stocks that have been going sideways and are breaking out. And you could see here is a positive move on Compass Diversified Industrials. Today pays an 8.6% dividend. It's going to have a 61 cents versus 43, so that's pretty health growth coming. Has a minuscule PE, and if you look at the news, distribution, all right, so is Compass being bought? All right, so I probably have to go back and look at why all the lawyers are there before I get that excited. MLYS, don't know this company from Adam, but it's an interesting looking chart. Massive breakout here on volume. Slowed down, pulled back, and broke out again today. MLYS, it's got the two momentums. And then Pepsi, which I think we looked at already, which looks pretty good and pays a nice little dividend breaking out here as well. Two dots. So that's what that one is for. So those look interesting, although I'm not in a buying mood right now. And A is going to look for stocks that have the week. Let me just pull one up. There's one of the ones we talked about that the government invested in. It's going to require the weekly bongo, which is on the bottom, to be blue. So the weekly is in an uptrend. It's going to require the daily to have reversed from red to blue within 9 bars. It's going to require that either have a MOBO or momentum or a breakout bar. This one has a momentum breakout and pocket pivot volume. It requires the squeeze and the relative strength and OBV signals like the other. So it's a pullback in an uptrend in a squeeze with a breakout and supporting evidence with the on-balance value and the volume and the relative strength. So HR is a healthcare realty trust. So loaning money to doctors or leasing doctors buildings is a safe business historically, pays a dividend of 7.39. Kind of steady eddy on earnings, not much difference in revenue. Um, Here's that MLYS again. There's Philip Morris. MP, like I said, that's one of the minerals. Why is it up today? It's probably up today because the world is freaking out. That looks like, is that Philip? Kind of looks weird. Let's go back to that. Yeah, it's up today because the world's freaking out about rare earth metals. NESR, what is this one? National Energy Services Reunited. Okay. It doesn't like when I hit it all the time. Pepsi, we talked about already. SWKH. Okay, I don't let the thing finish its cycle, and that's why it bounces around. Let's hit this again, because I get frustrated if it takes more than a second. Right. Zymeworks looks really good too. Pull back, breakout. So look, there's a few stocks that look attractive. I don't buy stocks in front of I don't walk across the street in front of a runaway semi coming my way, and I don't think I would be buying stocks personally at the open until I see what the market does on Monday. Let me talk to you Sunday night when I see what the futures are doing. And again, after doing this for a while, we have three things that can happen at the open. We open up flat, and that doesn't tell me much. Now, if we don't do much for 3 or 4 days after this pullback and we go sideways above the 50, that would be kind of awesome because that would tell me we're consolidating and then we might be going higher and running into the end of the year. I think that would be the best. If we open down 300 or 400 points on the Dow and the NASDAQ and people think it's horrible, it's horrible, it's horrible, then I'm going to be watching. What am I going to be watching? I'll tell you what I'm going to be watching. I'm going to be watching my buckets. Why? because the buckets will start to improve and you have to clip it during the day up here for it to update. I'll be watching the buckets and I'll be watching the daily briefing to see if the number of advances starts to go up. When they start to go up, then I know the market's going to follow. And if the markets open down a lot and close up on the day with a hammer, then I will be, before we get to the end of the day, I will be covering my short positions, which are mostly puts, and I will be potentially looking at adding things at lower prices. And if we open up 200 to 300 points, I'm going to be very skeptical and expect us to fade. So I have to see what the futures are. I got to see what we open. So I'll take a flat open. And although it sounds counterintuitive, I take a big down open rather than a big open, a big up open. And we may end up in the same place, but it'll be a lot prettier candle if we open lower and close higher than the other way around. Hope you don't mind my ranting and ravings. I went on forever. This is a pretty critical day. We'll see you all Sunday night.